As I'll show you, silver is already poised for a breakout. And now, just in front of us, is the catalyst for that potential breakout: tariffs, which will be implemented by the Trump administration on April 2nd. In this silver-centric market commentary for Friday, March 21st, 2025, I'll drill down on the implications for tariffs on the spot price, the silver supply, and the premium for fabricated products. Hi, I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas. We are a national physical precious metals dealership, and if we can help you with any of your physical needs in the precious metals arena, we'd love to have that opportunity. In this market commentary, I will review with you the impact of tariffs on the spot price of silver, on the physical supply of silver, and on the premium for fabricated silver products. Let's take a look at the latest silver charts and show you why silver is already poised for a breakout. As you can see on this 1-year silver chart, silver is entering into its second inverse head and shoulders pattern. The first one occurred from May to October, and then silver broke out, and now we're seeing a second inverted head and shoulders pattern. Now, the key to this pattern is the neckline. And as you can see on the red arrow in early October, that's when I produced the video titled, "Is Silver Ready to Run?" Because I saw the pattern shaping up and we were approaching the neckline with the inverted right shoulder. And that's exactly what happened. Silver broke from about $32 an ounce all the way to almost $35 an ounce. And now we've entered into the right shoulder of a second inverted head and shoulders pattern with a neckline at about 34.70. And we're right close to the edge right now. So the question is, will tariffs be the catalyst that pushes silver higher? Will silver jump up dramatically, or will it grind higher like it has been? Now, one of our account managers, Matt Warden, likes to say silver likes to take 1 step forward and 2 steps back. But over the past year, we've seen that pattern change, with silver taking 2 steps forward and 1 step back. So I think we're ready to see silver pop higher. It's just a question of how much and how fast. If you take a look at the 6-month candlestick chart, you can see how dramatic this inverse head and shoulders pattern really is. And the volatility in the silver market, we've seen higher lows and now we're seeing higher highs, and we're ready to go. So I do think that the imposition of tariffs on silver on April 2nd, which are highly likely, could be the catalyst to move this market higher, and it's already set to go. The question is, are we going to grind higher, or are we going to see a real pop, taking silver up 30 or 40% into the low 40s? That's anyone's guess. But the fundamentals underlying the silver market are extremely strong. If you look at the supply and demand for silver going back to 2016, according to the Silver Institute, the last time we had a very large supply deficit was in 2020, when we had a total deficit of about 300 million ounces. But a lot of that was due to investment demand that is absent from the market right now. We already have about a 250 million ounce supply deficit for 2024, according to the Silver Institute. And that is absent real material investment demand. So if we see investment demand for silver surge higher, that'll make a big difference right now. And we're getting very close to, I think, that happening with the way this market is shaping up, with silver ready to break out, and the way the whole economy is going, and the way interest rates may go. This is an article from Bloomberg from a couple of days ago. Global silver market faces strains as Trump tariffs hit. The silver market faces mounting stress as trade war concerns intensify, with silver rates to borrow metal adding to the sign of the global dislocation. A surge in lease rates for the precious metal has become the latest sign of alarm. And if you look at the lease rates, they're back up for a 1-month lease rate over 6%, which is extremely high. This is the interest rate to borrow silver for 1 month. Now, we saw interest rates spike going into December, January, and February with that huge movement of physical silver and gold into the COMEX exchange, primarily from London. It calmed down a bit, and now it's spiking up again. And that is a sign of a big demand for silver in the marketplace right now. So we've got another wave going on where silver is trying to come into the marketplace as fast as it can to get ahead of tariffs. And that's what the lease rate spiking is an indication of. Now, according to 2 analysts in the Bloomberg article, the market may be underpricing the scale and impact of the upcoming April 2nd U.S. reciprocal tariffs, Citigroup analyst Max Layton said. There may be substantial potential upside should reciprocal tariffs be implemented over the next 6 months. And according to TD Securities analyst Daniel Ghaly, who also signaled concerns, if reciprocal tariffs are really like for like, you would expect retaliatory tariffs on Canadian silver, and that's about 20% of U.S. imports. So these 2 noted analysts are looking for volatility in the market, and I expect that to happen as well when tariffs are announced, because no one knows how much, how big they're going to be, or how long they may last, and it's going to create a bit of a shock to the financial system across the board, and gold and silver are likely to be affected by that to a pretty strong degree. So until things settle down, it's going to be pretty bumpy. When you look at how much silver the world produces on an annual basis, the mines around the world produce about 830 to 850 million ounces. Mexico is by far the largest physical producer of silver out of the mines at over 200 million ounces per year, with China and Peru coming in second and third at a little over 100 million ounces a year. So between those 3 countries, they produce about half of the world's silver mine production. And of that, the U.S. imports about 40% of our silver from Mexico and 17% of our silver from Canada. So by far, our 2 largest trading partners, Canada and Mexico, provide for the U.S. the majority of our silver imports. And if we put blanket 25% tariffs on everything coming in from Canada and Mexico, it will affect the silver price sharply. But it could be just a volatility surge and a price surge that may not hold. Time will tell. But it's going to be pretty exciting, and it's going to be bumpy. So I do think we'll see a spike in silver. I do think it could be volatile, maybe difficult to trade. And the reason I'm putting this video out is so you can get ahead of it if you'd like to. So let's now consider how tariffs might affect the physical silver market in the U.S. Well, they already have. I detailed that in our video, The Truth About Gold and Silver Flowing into the U.S. I've been fortunate to get to know through LinkedIn a little bit an analyst by the name of Robert Gottlieb, who is a former HSBC managing partner. He's deep into the silver and gold markets with vast experience. And according to Robert, since December 4th of 2020, an astounding 149 million ounces of silver have come into the COMEX exchange. And since December 4th, 24 million ounces of gold. Now, compared to COVID, we saw about 80 million ounces of silver come into the U.S. market and an equivalent 24 million ounces of gold back then. Now, the difference then was that physical demand for gold and silver was through the roof, and we're not in that kind of a marketplace right now. And we already have almost twice the amount of physical silver parked in New York COMEX warehouses. So there's a really big supply that has front run the tariffs into New York COMEX warehouses. And according to my sources, colleagues of mine who I've known for almost 45 years in the market, they tell me that for production and industrial uses, the silver that is already in the COMEX exchange is equal to about 6 months worth of supply under normal demand conditions. If demand ramps up, it'll last a little bit less time. And if demand is quiet, it'll last a little longer. According to Robert Gottlieb, we cannot ignore that 149 million ounces that have moved into the COMEX and the liquidity it has caused in London. So that's a strain on the physical supply in London, which is one of the reasons why I think silver is close to a tipping point. Not to mention the sky-high lease rates that should only worsen. For this reason, I maintain we will see silver outperform gold in 2025. And I agree with Robert. I think gold has potential to go up about 10% from here into the $3,300 to $3,400 range, maybe $3,500 range. But silver could easily be 30%, 40% higher into the low to mid 40s. And another reason I appreciate knowing Robert is because he says, let's finally dispel all these crazy rumors about banks being short the world supply of gold and silver and need to cover. The CME is a futures exchange. However, it is backed by physical. For all those that are saying the CME is just paper and claiming all other absurd theories like banks are short the world supply of gold and silver, please stop talking your position and spreading disinformation. And I agree with Robert. It's my job to be a rational voice in a sometimes irrational room, to deliver to you factual, timely, and actionable market information, which is why I'm taping this video on silver today, because I do think silver is poised to go. And if you want to get ahead of it, if you want to add to your position, I don't think you've got much downside risk, and I think you've got a lot of upside potential. It's my personal opinion, and that's why I'm creating this video today. So thank you to Robert Gottlieb. Now, another sign of strain that we're seeing is the premium on 1,000-ounce silver bars is high right now, dealer to dealer. Now, when the mines produce silver and silver goes to the refineries, it comes out of the refineries in its largest form as a 1,000-ounce bar, which weighs about 80 pounds. I'm sorry, it weighs about 70 pounds and is about 1 foot by 4 by 4. It's a big, heavy bar. And this is what gets sent to other refineries to be turned into 100-ounce bars or turned into 10-ounce bars or 1-ounce coins or silver shot, which are pellets of pure silver. And getting into the supply, we already have a very large supply in the marketplace, as I've indicated, by what's in the COMEX warehouses. But when premiums on the 1,000-ounce bars are high, that means dealers are willing to pay a premium to get their hands on more physical silver right now, which is another positive sign. So we've got some volatility in the potential silver price with a very high likelihood of a breakout for silver. We've got a big supply of silver in the marketplace already, but premiums on the 1,000-ounce bars are a little bit high right now, which signals tightness, as do the lease rates. So let's now get into what's happening with the fabricated bar and coin premium impact. So the world's most popular silver coin in the United States is the 1-ounce silver eagle. It's already here. It's not going to get tariffed. That's the good news. The bad news is, on a monthly basis, the U.S. Mint manufactures silver eagles to order. And their capacity, as we learned during COVID, is about 900,000 ounces per month. So if there's more demand than that, and the U.S. Mint has to go to market to buy silver to get the blanks, to strike the coins, and the premiums on the 1,000-ounce bars are already kind of high, that means replacement cost to create new silver eagles can surge. And we've seen that during COVID. Silver eagle premiums got all the way to about $15 or $16 an ounce over the silver price. And if you paid that premium back then, you're still probably a little underwater on your silver purchase, which is a shame. It's an outright shame. That's why we sold a lot of Maple Leafs out of Canada and a lot of Austrian Philharmonics, which had much lower premiums at the time. So the U.S. Silver Eagle market is a bit vulnerable to a surge of demand, which a higher price could bring because of this equation. Higher premiums on 1,000-ounce bars and a limited amount of capacity. The good news is I have it on good authority from a couple of sources that the Royal Canadian Mint has already placed an abnormally large amount of Canadian silver Maple Leafs into U.S. warehouses. So there's a big stockpile of physical silver Maple Leafs already here. And in fact, we're having a special on backdated Canadian silver Maple Leafs at just $1.99 over spot right now. If we run out of those, we can go to the 2025s and for the time being get a pretty good premium, low premium on those as well. So the physical silver supplies right now in the U.S. are pretty good. Now, we're not sure if we're going to see tariffs on EU products, which would mean refinery-made bars coming in out of Switzerland may not be impacted by tariffs. And that means the physical supply of fabricated products, the premiums for what's already here and already made, are probably going to be low still, even if the silver price pops. Now, Silver Eagles remain a bit vulnerable, but there are enough silver Maple Leafs to go around for 3-4 months, I would imagine, depending upon demand. And a couple of my colleagues and I concur that the tariffs that we probably will see on silver may not last more than 3 to 6 months. All the tariffs may not last longer than 3 to 6 months because this is a negotiating tactic and it is destabilizing on all of the world's trading partners with this tariff tit for tat reciprocal tariffs that are going to be deployed. So it's very possible that President Trump may actually get his way and see tariffs on U.S. exporters by the countries we export into be dropped. And if that's the case, and all the tariffs are dropped 3, 4, 5, 6 months from now, the U.S. will be in a better exporting position and will get back into normal market trading, which is what a lot of people think could actually happen. And I think that that's probably a pretty high likelihood of occurring as well. So that is what I wanted to talk about with silver. Let's take a quick look at gold. Here's a 1-year gold chart showing gold's dramatic rise since the inauguration day on January 20th, as indicated by the number 47 at 27.50. Gold's gone all the way to 30.49 an ounce in the futures market on the close. Now we've got a liquidity event going on right now today, Friday, March 21st. So gold is down about $25. It's about 30.15 in the spot market. Silver's down about 50 cents today at about 32 and change, 32 and a quarter in the spot market. So it's giving us a little bit better buying opportunity, but I do think silver in particular is poised for a breakout. And that right shoulder inversion completes on the inverted head and shoulders pattern. You know, a pop is likely. So if you're interested in adding physical silver, I wouldn't dally. If you've never bought physical precious metals, we do have a getting started guide. There'll be a link to it in the video right below where you can go online and have us send you one, and we'd be happy to do that. We do have a silver Maple Leaf special, as I indicated. And this is how you'd contact us if you'd like to. And as always, thank you to our loyal clients and the trust that you've placed in us for the last 27 years. Without you, we wouldn't have a business, and never a day goes by that we aren't grateful for your loyalty, your trust, and your support. So it's going to be pretty exciting as things continue to change, and it's going to be a bit bumpy ride for the next couple of months till we see how the tariffs are deployed. President Trump said just today that there will be some flexibility, so we'll see what that means. So good luck out there, and thanks again.